Okay, so you're looking at a company's financial reports, and it feels like, I don't know, trying to read a different language, right? All these debits, credits, maybe terms like provisions. It's confusing.
It really is. It's the language of business, plain and simple. And what we want to do today is kind of give you the translation guide.
Exactly. We've got this pile of, let's be honest, pretty dense source material. The rules, the standards.
Yeah, the stuff that usually takes ages to really get your head around.
And our mission is to boil it all down. We're aiming for a clear, four-step framework that covers the whole accounting cycle.
Think of it as your shortcut to fluency. We want to show you the complete flow from like the moment something happens in a company all the way to analyzing its financial health.
A navigation system, basically, so you don't feel lost in the jargon anymore.
Right. And we've structured this around what we're calling the four-column framework.
Makes sense.
Right, makes sense. What are the columns? Okay, column 1, transactions. That's about how something even gets recorded. Column 2, financial statements, the actual reports. Column 3, concepts, the underlying rules, the why. And finally, column 4, ratios turning numbers into insights.
Got it. Transaction statements, concepts, ratios, start to finish.
Yeah, we'll show you the whole flow so you can kind of anticipate what's coming next.
Perfect. So let's jump into column 1, transactions. The starting line. Does, like everything a company does, end up in the accounting records, say a big strategy meeting or a new HR policy?
Good question. And the answer is surprisingly no. That's actually the first big hurdle.
Really?
Yeah, not every single activity qualifies as an accounting event. For it to hit the books, it needs to meet what we call the recognition criteria. Recognition criteria. Okay, what does that mean in plain English?
It means two things, essentially. First, you have to be able to reliably measure the event in money. Cold, hard cash value.
Okay, measurable in money.
Yeah.
Like buying supplies. Exactly. And second, it has to actually impact the company's financial position. So it needs to affect assets, liabilities, equity, revenue, or expenses, the core elements.
Right. So buying supplies is definitely measurable, affects assets, affects cash, but say interviewing a potential CEO.
Yeah.
Huge deal for the company, but
But no immediate measurable financial impact right then and there. So it's a critical business event, sure, but not an accounting transaction yet.
okay, that distinction's important. So once it is recognized, how do we measure it? Is it just what we paid?
Well, typically the sources stress using fair value for the initial measurement.
Fair value. That's like market value.
Pretty much. Think of it as the price you'd get if you sold that asset today, or what it would cost to transfer a liability now. It's very market-oriented, not just the historical price tag.
Which makes sense in today's economy. Things change fast.
Yeah.
What about international stuff? Buying those supplies in euros when your books are in dollars?
Right, that adds a layer. If foreign currency is involved, the rules specifically IFRS 21, if you want the detail, say you must convert it using the exchange rate that was valid on the day the transaction happened.
Not just an average rate for the month?
No, the specific rate on that specific day. Precision matters there.
Okay. Recognized, measured. Now we record it. This is where that double entry thing comes in.
Exactly. The double entry system is kind of the genius backbone of accounting
My genius.
because it's got this built-in error check. Every single transaction hits at least 2 accounts as a debit in one and equal credit in another. Always.
So debits always have to equal credits.
Always. And because they have to balance, the fundamental accounting equation,
Yeah.
assets, liabilities plus equity, always stays in balance too. If it's out of whack, you know you made a mistake somewhere.
That makes sense. It forces accuracy.
Yeah.
So where do these debit and credit entries actually live?
They get recorded or journalized
Hmm.
and then posted into the ledgers. Think of it like files. You've got the detailed files, the subledgers.
Like every single customer's invoice.
Precisely. All the nitty-gritty detail. And then all that detail gets summarized up into the main categories in the big book, the general ledger, or GL.
Okay, subledger for detail, general ledger for the summary totals. And after all that tracking, what's the first big output? The accountant's first check.
That would be the trial balance, or TB.
The trial balance.
Yep. Once everything's posted to the GL, you pull a list of all the final account balances. It does 2 main things. Gives you a summary of everything, and crucially, it confirms that your total debits still equal your total credits across the entire company.
Ah, so it's the final proof before you build the fancy report.
Exactly. The sources literally call it the backbone of all financial reports.
Mm-hmm.
It's the accountant's way of saying, okay, the underlying numbers are sound. It's their signature deliverable. in a way.
Okay, that's a key point. The TB verifies the data. So with that verified data, we can move to column 2, the financial statements. This is what most people see.
Right, this is the formal output, the story the company tells the world. And there are actually 5 main statements, though people often focus on maybe 2 or 3.
Let's quickly run through them. What are the big 5?
Okay, first, the balance sheet or statement of financial position. That's a snapshot. What you own, assets, and what you owe, liabilities and equity, at one specific point in time, like December 31st.
Static picture, okay.
Then the income statement, or profit and loss. This measures performance revenue minus expenses over a period of time, like the whole year.
Performance story.
Yep. Third, the cash flow statement. This tracks the actual cash moving in and out, broken down into operating, investing, and financing activities. Where did the cash really come from and go?
Got it. And the other 2, less common, maybe.
A bit less talked about sometimes, but important. There's the statement of comprehensive income. It basically extends the income statement. It includes gains and losses that haven't necessarily turned into cash yet, like changes in the value of certain investments or foreign currency effects.
The other stuff that affects overall wealth, but isn't pure profit loss yet.
Kind of. And finally, the statement of changes in equity. This one details everything that changed the owner's stake in the company during the period, new capital, profits kept in the business, dividends paid out, etc.
Okay, 5 statements giving the full picture. Now, you often hear managers obsessing over the income statement, right? The profit number.
Oh, definitely. That's often the headline number.
But the sources we looked at suggest accountants internally might prioritize the balance sheet more. Why is that?
It comes down to control and auditability. The balance sheet represents the fundamental state of the company. Think about regulations like Sarbanes-Oxley, SOX.
Right, post-Enron rules.
Exactly.
Yeah.
They put huge emphasis on internal controls.
Yeah.
And a key control is that all the significant balance sheet accounts, cash, receivables, payables, inventory, must be reconciled, meaning checked and verified against supporting details every single month.
So if the balance sheet accounts are solid and verified,
Then the resulting income statement figures, the profit, are much more likely to be reliable. It's about ensuring the foundation is strong. The balance sheet is that foundation.
that makes sense. Let's circle back to the income statement then.
What's
How
the-
does revenue get recognized? Is it just when you send the bill?
Not quite. There's a whole standard for it, IFRS 15. It lays out a 5-step model. But the core idea is that revenue is recognized when the customer gets control of the goods or services you promised.
Control, not just possession.
Right. When they can direct the use of it and get the benefits. And for expenses, it's not just about when you pay the bill either.
The matching principle.
You got it. You have to match the expense to the revenue it helped generate in the same time period. If you sell something in December, the cost of making that thing needs to be recorded as an expense in December too, even if the supplier bill isn't paid till January.
Effort matched with reward. Okay. And this matching, this accrual idea is why profit on the income statement isn't the same as cash in the bank, right?
Absolutely. That's precisely what the cash flow statement is for. It starts with that net income figure from the income statement,
The accrual number.
and then it adjusts. It adds back non-cash expenses like depreciation. You record depreciation as an expense, reducing profit, but no actual cash leaves the building that day.
Right. It's an accounting entry reflecting wear and tear.
Exactly. And it also adjusts for changes in working capital, like if your customers owe you more money, higher receivables, or you built up more inventory. Those things affect cash flow, even if they don't directly hit the profit number in the same way. It reconciles profit back to actual cash.
The ultimate reality check. Okay, that flows nicely into column 3. Core accounting concepts. These are the rules of the road that dictate how we apply things like matching and recognition.
Exactly. These are the principles that ensure consistency and hopefully truthfulness in reporting. If you get these, you really get the why behind the numbers.
So what are some key ones? We mentioned accrual basis already.
Right? Accrual basis is fundamental. Record things when they happen economically, not just when cash changes hands. It gives a much better picture of performance over time.
Makes sense. What else?
A really distinctive one is prudence, sometimes called conservatism.
Yes, conservatism. Sounds cautious.
It is. The basic idea is anticipate and record potential losses, but don't anticipate or record potential gains until they're virtually certain.
So if a customer looks like they might default, you make an allowance for that potential bad debt now.
Correct. You account for the possible loss. But if you think you're about to land a massive new contract, you don't book that revenue until the ink is dry and control has passed.
So when in doubt, lean towards understating assets and income and overstating liabilities and expenses.
That's the essence of it. When in doubt, accrue is a bit of an old accountant saying, especially for potential costs. Better safe than sorry is the underlying philosophy.
Interesting bias built into the system. What about going concern?
That's the bedrock assumption,
Hmm.
really. We prepare financial statements assuming the company will continue operating for the foreseeable future, at least the next 12 months.
And if that assumption isn't valid, if the company might go under.
Then the whole basis of accounting changes. You'd switch to a liquidation basis, valuing assets at what they'd likely sell for in a shutdown, which is usually very different.
Crucial assumption then. And substance over form. That sounds important for complex deals.
Hugely important. It means you account for the economic reality of a transaction, not just its legal structure or paperwork.
Can you give an example?
Sure. Say a company has a lease for a piece of equipment. Legally, it's a rental. But if the lease term covers almost the entire useful life of the asset, and the payments basically cover the full cost plus interest.
Then economically, it's like they bought it.
Exactly. The substance is a purchase, even if the form is a lease. Accounting rules say you have to reflect that substance, treat it like an asset purchase on the balance sheet.
Got it. Reality over paperwork. Now, let's apply these concepts to something specific on the balance sheet liabilities. We hear terms like accrued expenses, provisions, contingent liabilities. They sound similar.
They relate to uncertainty,
Mhm.
but there are clear lines. An accrued expense is the most certain. You've received the benefit like using electricity all month. You just haven't gotten the bill yet. You know you owe the money.
Okay, definite obligation. Just timing of the bill is unsure. What about a provision?
A provision, like for a warranty claim or a lawsuit, involves more uncertainty, but it still needs to meet two tests under the rules, like IS 37. First, the obligation must be probable, meaning more likely than not, usually interpreted as over 50% chance.
Probable.
And second, you need to be able to make a reliable estimate of the amount. If both are true, you record the provision as a liability on the balance sheet.
And if it's not probable, or you can't estimate it reliably.
Then it becomes a contingent liability. You don't put it on the balance sheet. Instead, because of prudence, you have to disclose it in the notes to the financial statements. Tell people about the potential risk.
So accrued, certain, provision, probable and estimable, record it, contingent, possible or not estimable, disclose it.
That's the hierarchy,
Yeah.
exactly. Crucial for understanding potential risks hidden in the notes.
Definitely. Okay, we've covered the event, the recording, the rules, the statements. Let's hit column 4,
Right.
ratios. This is where we turn all that data into, well, useful information.
Right. Ratios are fantastic tools for analysis. They help you compare performance over time or against competitors. They connect the dots, especially between the income statement and the balance sheet.
But you mentioned a potential pitfall here, something analysts mess up.
Yes, the stock versus flow distinction. This is super
Yeah.
important, but easy to get wrong.
Remind us what that means again.
Okay, remember, the balance sheet is stock. It's a snapshot at a single point in time. Think, a photo.
Right, December 31st balance.
And the income statement is flow. It measures activity over a period. Think, a video recording of the whole year.
Okay, photo versus video, stock versus flow. Why does that matter for ratios?
Because often you're comparing a flow number, like net income for the year, to a stock number, like total equity at year end. For example, return on equity, or ROE. That's net income divided by equity.
So you're dividing a full year's profit by the equity figure from just the last day of the year.
Exactly. See the mismatch? You're comparing a 12-month flow to a one-day stock. It's not a fair comparison, especially if equity changed a lot during the year.
So how do you fix it? How do you compare apples to apples?
You have to use an average for the balance sheet figure. So for 2024 ROE, you'd take the net income for 2024 and divide it by the average of the equity at the start of 2024 and the equity at the end of 2024.
Average the beginning and ending balance. That smooths out the stock figure to match the flow period.
Precisely. It makes the comparison meaningful. Always use average balance sheet figures when mixing them with income statement flows. Critical detail.
Got it. Average the stock. Okay, let's quickly touch on the main types of ratios. What categories help tell the company's story?
Generally, we group them into 5 key areas. First, profitability ratios. Pretty obvious, how good is the company at making money?
Like gross profit margin or maybe return on assets, ROA?
Exactly. They measure efficiency in generating profit from sales or assets. Second, Liquidity ratios. This is the immediate survival check.
Can they pay their short-term bills? The current ratio is a classic here, right? Current assets over current liabilities.
That's the one. If it's dipping below 1, meaning short-term debts are higher than short-term assets, that's potentially a red flag for cash flow problems. It's a real gut check.
Okay. Then third, leverage ratios. This is about risk, isn't it?
Yeah, financial risk. How much debt is the company using? The debt-to-equity ratio is a key indicator here. It tells you how much the company relies on borrowing versus owner's capital.
More debt usually means more risk, but maybe higher potential returns too.
It's a balancing act. Fourth, efficiency ratios. These are about operations. How well is the company managing its day-to-day activities?
Like how quickly it sells inventory
Right.
or collects cash from customers.
Exactly. Inventory turnover, days sales outstanding, DSO. And the big one that combines several aspects is the cash conversion cycle, or CCC.
Ah, the CCC. That sounds complicated.
It measures the time in days it takes for a company to convert its investments in inventory and other resources back into cash from sales. You basically add the days inventory sits around, DIO, and the days it takes to collect from customers, DSO, then subtract the days you take to pay your own suppliers, DPO.
So DIO plus DSO, DPO. A lower number is better, means you get your cash back faster.
Generally, yes. A shorter cycle means the company's operations are generating cash more quickly. It's a great measure of operational efficiency.
Cool. And the final category.
Fifth, valuation ratios. These are more market-focused, often used by investors.
Like the PE ratio, price to earnings.
That's the most famous one. It shows how much the stock market is willing to pay for each dollar of a company's earnings. Gives you a sense of market expectations.
Okay. Profitability, liquidity, leverage, efficiency, valuation. Covering all the bases. What a tour.
It is a full cycle, isn't it?
Yeah. We started with just an event, saw how it gets recognized and measured, then recorded using that double entry system.
Which ensures balance and allows us to produce the crucial trial balance.
The verified data that feeds into the 5 main financial statements.
Which are prepared according to core concepts like accrual, matching, going concern, and that cautious principle, prudence.
And finally, we analyze those statements using ratios, always remembering to use average balance sheet figures when mixing stock and flow.
You've got it. That's the whole journey in a nutshell.
So, wrapping up, the big takeaways for you listening. First, that trial balance. It's not just internal plumbing, it's the key to data integrity. Second, remember accountants often focus internally on the balance sheet for control. If that's solid, the rest is more reliable. And third, ratios unlock insight, but only if you respect that stock versus flow difference by averaging.
Absolutely spot on. And maybe one final thought to leave you with, circling back to that concept of prudence.
The conservatism bias.
Right. If the rules of accounting inherently make us anticipate losses, but ignore potential future gains until they're almost certain, how does that shape our view? Does that systematically conservative profit number we see truly reflect the full potential, maybe the more aggressive upside, of a forward-looking company?
Does prudence make us underestimate future success?
It's something to think about. Does the caution built into the numbers potentially mask the true trajectory? Something to ponder next time you're looking at those reports.
An excellent question to mull over. That's all the time we have for this deep dive.